I'm Will Peeler, and this is another installment of Tailgate Talks, where we sit on a tailgate and, well, talk. And I'm joined today by Natalie Corontzes and Phil Long, both lenders in our Spartanburg branch. Natalie, tell us a little bit about what you do at AgSouth.
So I am one of our loan officers, a branch loan officer. We typically like to call ourselves relationship managers. And so a lot of what I do, I make a lot of our farm and agricultural loans, and I also service those loans throughout the life of their accounts. So I'll be someone that will take care of that account throughout the life of the loan.
Tell us about some of the products that you offer.
So we do a lot of vacant land loans for the purpose of building your primary residence or for the purpose of having some type of recreational hobby farm. But we also offer equipment loans and pretty much anything for agricultural purpose we can help.
What's a typical term? Say somebody wanted to buy 10 to 30 acres of real estate just to have a bigger backyard, or maybe, like you say, eventually build a house on, or use it for recreational purposes with a pond, hunting, riding four-wheelers. What's a typical term for a loan like that?
So typically that type of product would fall into one of our farm loan products. You're looking at standard about a 20-year fixed rate term with no prepayment penalties and up to 85% financing.
Phil, tell us a little bit about what you do and if it's any different from what Natalie does.
Sure. Well, I work for the home loan division of AgSouth. And so anytime the property comes in, somebody wants to finance it's going to be more residential, whether it's an existing home or they want to build a new primary residence or their forever home, then I typically get involved. And we source our money differently than the farm loan so that we can offer competitive interest rates and loan terms relative to our home loan competitors in the area.
You hear a lot of buzz in the industry about C2P. What in the world is a C2P? How does that work? What is it?
Well, C2P just is an acronym for a construction to perm product that we offer. The big advantage of it is you close one time up front so that once your house is finished, you complete some modification paperwork, but you do not have to go through the underwriting, appraisal, and closing process again, saving you thousands of dollars while you're building the primary residence.
What is a typical term for a loan with somebody that closes at your division?
Sure. So our construction loan consists of two loans really combined into one closing. You have a 12-month interest-only construction phase, and then once we modify, we roll that into a 30 or a 15-year fixed-rate conventional mortgage. And it's important because they do deal in fixed rates so that market changes do not impact your mortgage payments.
Phil, with the C2P, the rate that is in place when they first close the loan, is that the rate throughout the life of the loan, that whole 30 years?
Good question. One of the big benefits of this loan product is we have the ability to float down to market rates once the house is finished and we're getting ready to execute the modification paperwork. So if rates have come down 1.5%, 2% in some cases, we'll be able to take that customer from a higher rate to a lower rate with no additional charges to that customer.
So you're both in the same office. You offer two different products. Are there scenarios where the two of you could work together? Natalie, have you had a borrower who has worked with you and done some work with Phil?
Absolutely. So a lot of what we will do is financing the land on the front end can make it a little bit of a smoother process to give our customers time to get their building plans together, make sure they know exactly what they want. And so a lot of times we work together. I will finance the land side of it. And then when they're ready to build, we can either cut out a portion and release that from our loan, or they can roll the entire loan into a construction loan through Phil.
Phil, have you seen much success with working jointly together with our ag side of lending?
Oh, absolutely. It's just a huge benefit to be able to offer farm loans and home loans right out of the same office, even though it may be under different loan offices. Because I constantly get calls for people who want to finance land and farm. And sometimes they want land to build on, but they're not quite ready to build. And so Natalie and I will work together to get that customer over to her and let her help them acquire the land. And then once they finalize their building plans, they'll come back to me and we'll work on the construction loan, get their house built, and get them moved on along.
Well, we're talking two different products, two different lenders, two different kind of divisions of AgSouth. What are some of the similarities, Natalie, that you see between the product you offer and what Phil offers?
Yeah, so I would say a lot of the product similarities would be in just the process in general. We're going to require an appraisal. We're going to require lender's title work. So it's going to follow the same process. I would say really your biggest differences would be more your small pieces. So your appraisal is going to take a little bit longer. Another thing, when you're buying a house in a subdivision, you're typically going to have a developer that came in and surveyed square lots. When you're purchasing vacant land, we've got to have a survey every time. Sometimes that can be a 3 to 6 week process to get that survey. So there's definitely nuances that are different when financing land that you should be aware of up front, but the process in general is pretty similar.
Being familiar with both of your products, I will say that the rates that your division offers are typically lower than what Natalie can offer. Help me understand why that is.
So as I mentioned earlier, our money on the home loan side, assuming it qualifies as a residential property, is sourced differently than the farm side. We're essentially accessing government-sponsored money through Fannie Mae, Freddie Mac, or the Federal Housing Administration, or a couple of the options. And typically, for long-term mortgage rates, that's where you can access the cheaper money. And that's why we offer those home loans, is so that we can be competitive, because most residential customers would prefer to pay a lower rate on a home loan versus a farm rate, where you're typically going to pay a little more in interest.
One thing I'll say about that little bit higher rate, when you're purchasing land, that is a riskier type of loan for a lender. And so with any lender you go through, you're typically going to pay a little bit higher rate. We like to kind of explain this in very simple terms, that if you have a mortgage on your home and you have a mortgage on your hunting property and you lose your job, which one may you stop paying first? It'd probably be that hunting property.
Natalie, one of the biggest benefits of doing business with AgSouth Farm Credit is you become a member of the cooperative, which allows you to participate in the patronage programs. Can you explain a little bit about what that is and how that benefits our customers?
Absolutely. So when you take out a loan with AgSouth, you become a member of the association through a stock purchase fee. What that allows us to do is share our profits with our members. Now, what that really means for our borrowers is every year around April, they're going to receive a check back for a percentage of interest earned that they paid in over the course of the year. So one disclaimer I always like to put on that, it is subject to board approval each year. So it's not a guaranteed return. However, we have been returning patronage distributions consecutively for over 30 years. So I don't see that going anywhere anytime soon, but those percentages may fluctuate from year to year.
Well, what can a borrower do? Do they have to use that money to pay the loan down, or is that one of the advantages there?
Absolutely not. So that's certainly something that they can do if they choose to put that money towards principal. But that can also be shopping money. That can be for anything they choose. That's the benefit of doing business with AgSouth.
So no strings attached, but they literally get a check in the spring of the year for a portion of the interest that they pay back.
That's exactly right.
And Phil, I'm correct that somebody that comes through the mortgage division doesn't benefit from the patronage, but they have the lower rate on the front end.
That's correct. And that's also where Natalie and I will work together on some deals in trying to understand exactly what the customer's needs are. If they're going to be buying a house and some acreage and do some tree farming, and they need to have one of our open-ended mortgages, they still may have a better option with Natalie with the patronage to allow for future finance. Or if they're just buying a house and they just want to have something out in the country on a few acres, or a lot of acres for that matter, a lot of times the lower rate up front is going to be better for that particular client, just so that they're not having to pay in the rate and wait for it to come back in the form of a patronage dividend.
Phil, what about the loan-to-value requirements for your loans? Are they typically in the same ballpark as 85%, as Natalie mentioned? Can you do any more? Does it have to be more or less than that?
Yeah, another good question. We do have a little more flexibility with down payment options because we offer different types of residential home loans. We can do as little as 0% down with a USDA loan or a VA loan for our veterans. And of course, customers can always elect to put additional funds down, but we do have those programs with smaller down payments or no down payments in some cases.
Natalie, Phil mentioned an open-end mortgage, and probably a lot of our viewers don't understand what that means, but that is where we can finance additional purposes in the future after a loan is purchased and not have to go through another mortgage closing process. Explain where that might be something that a borrower with you might want to look into doing.
So that's a really big benefit for what we call relationship lending. When you're looking at growing a small farm, you may eventually need equipment. You may eventually need to take out a loan against property for some improvements. That's something that we can do without having to have you go back and refile another mortgage. So it's a way that we can kind of simplify the process, and if certain things qualify, sometimes we can make it a very quick turnaround. But really, the biggest benefit there is that we can continue to lend for the farm as you expand.
You mentioned the word timeline. Could each of you explain a typical timeline for somebody, let's say from the time they first talk with you to the time the loan closes? What's typical? I guess there's no such thing as a typical loan, but what's the ballpark figure of how long it takes somebody to get a loan closed?
So typical timeline on just the vacant land side, I generally tell people to have about a 45 to 60-day contract window. That gives us time if we find out that a survey needs to be done, if appraisal takes a little bit longer because it's a large tract. It definitely helps with some of those nuances through the loan process.
Phil, how about in the mortgage
for the home loans, typically if someone's purchased an existing home, I tell them to count on at least 30 days from the time we receive the executed contract. If they're doing a construction to perm, I ask them to allow 45 days from the time we receive the final build plans, build contract, and specifications. Of course, they can go a little slower and they can take a little longer. Everybody's situation has a little bit of a nuance to it, so it is a bit of a moving target, but typically between 30 and 45 days for most of our products.
Well, zeroing in on those construction loans, how does that process work with a borrower? They're in the process of building a house. How do they get the money to their contractor for those construction draws?
So when we close on a construction loan, we do not release a bunch of money to the builder for them to start working on the house. We close a construction loan, the build funds actually go into a construction draw account. And then as the builder completes work, they'll call for a draw. And we'll send out an inspection, verify how much of the project they have complete, and based on that percentage, and with the client's approval, we'll release that percentage of the build costs to the builder for them to pay their subs and material costs. And that process continues until we've paid the builder in full, house is complete, and we're ready to modify to a conventional loan.
Natalie, do you find that a lot of commercial banks are willing to loan on land for just vacant land like we do?
No, it's pretty scarce in the area. A lot of what we do is pretty unique. A lot of banks don't want to take the risk of financing land. They don't understand it. They don't know what appraisers to use. Like I said, there's just a lot of nuances with land that other banks don't know how to work with. So you run into that a lot.
Natalie, a lot of times we see commercial banks, if they're willing to do a loan on vacant land, their terms or what they're requiring is a little bit different than what that we do. What have you seen in your experience with that?
So, yeah, it all goes back to the risk aspect of it. So a lot of times what you see is higher down payment requirements if they are willing to lend on a piece of vacant land. But again, sometimes it can be a little bit higher rates, but typically it's that down payment required.
What about the length of time they're willing to put a loan on fixed rate? We don't always see them willing to do the full 20 years like AgSouth offers.
I have seen some banks offering some competitive 15-year rates, but for the most part, what you find is some type of ARM or some type of balloon term where it's a 3-year with an ARM or a 5-year with an ARM. And what's nice with a fixed rate is that, if plans change, things happen on your build side, you have still got that fixed rate for an entire 15 to 20 years. That that's not going up on you and there's not a balloon coming through.
So when you say balloon, you mean, explain to me what a balloon is exactly.
So that's typically going to be where you're set up on a term monthly payment for a certain period of time, whether that's 3 years, 5 years. And then at the end of that period, and that's going to be amortized over a 15-year period, typically at the end of that 3 or 5 year period, all the remaining principal is going to come due. So That's what I mean by a balloon. And that's one thing you would avoid going through AgSouth.
Phil, what do you see in the marketplace with the C2P product as far as other lenders being, what are they offering similar or dissimilar to what we do?
So the construction to perm market in our area is definitely a lot more competitive. Many times I find that we seem to be a little more aggressive as far as minimum down payment. So we'll do a construction to perm with as little as 5% down or 5% equity if they already own their land. Most construction lenders want 10 to 20% down. Some lenders do offer that float down we talked about earlier, as we do, and some do not. So in some cases, if you're doing a one-time close, you don't have a chance to get that lower rate if rates fall during the construction phase unless you go through the refinance process costing you thousands of dollars a week. So those would be the two big pieces. The last niche I would say is we are not scared of those larger acre properties. Somebody wants to build a house on 20, 30, 40, 50 acres. We'll tackle that loan and we'll get it closed. Whereas a lot of banks will try to encourage that customer to cut out a smaller tract, a 5 or 10 acre tract to build a house on, but then they don't get to take advantage of the lot area. So it really comes down to the customer's needs and what their long range goals are.
Natalie, any tips for someone who may be interested in buying and financing a piece of land with farm credit? What are some of the best practices that you would suggest?
My biggest tips would be keep an eye on your credit. That's something that a lot of people, can lose sight of. And credit is one of our very first and best indicators of how your repayment will be and what type of risk we're taking. Outside of that, keep good financial records, keep your tax returns up to date.
Phil, any suggestions to people potentially willing to borrow money on the mortgage side?
Absolutely. So the biggest thing, and I think this goes across a lot of industries, is having that open line of communication. And that's a two-way street from loan officer to client and vice versa. The second biggest challenge a lot of times is having the customer provide their documentation in a timely manner when it's requested. A lot of times underwriters will review files, and then as additional documentation comes in, it requires them to ask for further documentation. And sometimes customers are not impressed upon the importance of getting that back to us in a timely manner. So we try to do a better job of impressing that upon the customer, but there is some responsibility in that manner for the customer to get that information back to us as quickly as possible so that we can try to stick to that 30-day timeline to get their loan closed.
Phil, that's interesting you say that because that could affect the timeline that you mentioned earlier. A lot of that can be customer driven.
Absolutely. And I think part of our jobs, whether it's farm side or the home loan division, just comes down to us doing a good job of educating our customers about the process and helping them understand why these items are important to their underwriting and to their final approval so that we can close them in an efficient timeline.
Natalie, Phil, I appreciate you stopping by the tailgate today to talk with us. What's the best way if somebody wanted to get in touch with a lender on either the ag or the farm side or the mortgage side? What's the best way to find their local lender?
Well, you can call our office here in Spartanburg at 864-585-0344. They will direct you to Natalie or myself or even Amanda Moore. After a brief conversation, we'll try to make an assessment of what that customer's needs are and put them in the right hands, whether it should be on the farm side or with me with the home loan division.
But at any point, you can call any of our local branches. We have lots of numbers out on Google, and we will have someone route you to the closest branch and the best location for you.
Any website that would be best for anyone to check out?
AgSouth, F as in farm, C as in credit.com.
Follow us on Facebook.